أعوذ بالله الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي ثم أما بعد. So in our lesson today we shall be talking about the Islamic financial instruments, and it's a very important topic because when you're talking about the Islamic financial instrument, these are the instrument that Islamic banks they normally use when they are operating in their banks. So these are our lesson's objectives for this lesson today. By the end of this lesson, you will be able to do what? By the end of this lesson, you will be able to, number one, describe the concept of Murabaha, including its structure, how it differs from conventional financing, and its application in Islamic finance. Number two, explain the principle of Mudarabah, outlining the roles of the investor and the entrepreneur. Number three, identify the key features of Musharaka. Number four, clarify the concept of Ijara. Then lastly, we shall talk about Sukuk and how it functions, and also the difference between the Sukuk and the conventional bonds. So these are the lessons objectives for our lessons today. Now, so these are the instruments. There are very many instruments, but in our lesson today, we shall just focus with these 5 instruments because they are the main instruments when it comes to Islamic financial instruments. So number one is Murabaha, which is normally called the cost plus financing. So somebody might ask, what is Murabaha? So Murabaha is a significant contract type within the Islamic financial system, characterized as a cost plus financing arrangement. And in a Murabaha agreement, the seller, which in most of the time is the bank, the seller discloses the cost of an asset and adds a profit margin, which the buyer agrees to pay over a fixed period. And this structure is compliant with Islamic law, Sharia, because it avoids interest, riba, which is prohibited in Islam. So Murabaha is a cost plus financing arrangement, and we shall see we shall see in the examples how Murabaha can be calculated and real life examples. Now, what is the importance of Murabaha? Number one, it conforms to Islamic principles. That is, it adheres to the tenets of Sharia law by promoting trade and fairness while eliminating exploitative practices. So it conforms to Islamic principles, which state that when you're doing business, it should be fair, and people should not exploit each other. Number two, financing option. Murabaha offers an avenue for individuals and businesses to obtain financing for various needs without engaging in haram. So it gives people a platform or an avenue to obtain finance without involving ourselves in prohibited activities. Number three, it's transparency. Since the cost and profit margins are predefined even before the contract, So when you're engaging in the contract, we need to define the profit that each and every party is going to get, and this enhances transparency. Risk sharing, it provides both parties with an understanding of the risks and rewards involved, thus fostering a mutual trust. And what are the objectives of Murabaha? ما هي الأهداف المرابحة? So number one, it's facilitate trade. Because, for example, today, I want to buy something. I want to do a business. I want to invest in something. I don't have the money. So I will go to the bank. The bank will do the finance, and I will pay the bank later. So it facilitates trade. It provides financing to meet the financial needs of individuals and business in a manner that does not involve interest. So we have different kinds of businesses. And remember, businesses are based on finance. You cannot run business without finance. So the Murabaha can be an avenue, can be an opportunity for you to get finance from the bank. Then it promotes ethical transactions. That is, it ensures that all parties in a transaction act ethically and are fully aware of the terms. So these are the objectives of Murabaha. Now, to the most important part, what are the concepts? What are the concepts related to Murabaha? So number one, we have the cost, which is the actual purchase price of the asset being financed. Number two, we have the profit margin, which is the additional amount charged by the seller above the cost, which represent the profit. Then we have the purchase order, which is the request from the buyer to the seller, specifying the item and the terms of the trade. Then lastly, we have the payment terms. The payment terms, this is the agreed upon schedule for the buyer to pay the total amount, which is the cost plus the profit margin to the seller. So these are the basic concepts that are related to Murabaha. Now, what are the components of Murabaha? When you're talking about the components of Murabaha, we are basically talking about the parties involved, which the parties involved, there are usually two primary parties. That is the seller, the financer, which in our case is mostly the bank, and the buyer. Then number two, we have the subject matter. The subject matter, this is the goods or asset being financed, which must be halal in our case, you know. Then we also have the cost disclosure. That is, the seller must disclose the purchase price along with the markup. Then you have the payment terms, clearly defined payment schedule, which are the installment or lump sum. It can be paid at once. Then lastly, the legal contract, which is a formal agreement that outlines all terms and conditions of the Murabaha transaction. So these are the components of Murabaha, and it's very important to know these components. Now, these are the basics examples of Murabaha. For example, car financing. I want to buy a car. I don't have the money. What will happen? So a bank buys a car for $20,000 and it sells it to the customer for $22,000 on a deferred payment basis over 5 years. So here, the bank buys the car for $20,000, but it is selling it for 22. So this 22 is not an interest, because even before the transaction, the bank is going to disclose to the buyer, like, hey, this is the car, I bought it for 20, but I'm going to sell it for you for 22, and you'll have to pay for a given period of time. Home purchase. For example, if you want to buy a house, a financial institution purchases a property for $200,000 and sells it to the client for 220 with monthly payment of over 10 years. So the initial price of the house was 200, but the bank is selling for you for 220. So the 20 is basically the profit the bank is going to gain from this transaction. So it's not an interest. Equipment buying, a business needs machinery costing $50,000. The bank buys it and it offers to do what? The bank offers to the business for 55. So here there is an extra 5,000, which is the profit margin. Then Islamic insurance policy, for example, an insurer agrees to cover an asset for 10,000, charging the owner 12 as cost after managing fee over a year. Then lastly, inventory financing. You have your business, you want to increase your inventory. So a retailer needs stock. You need a stock worth 30,000, but you don't have the money. So you will approach the bank, and the bank will do what? The bank buys the stock and sells it to the retailer for 33,000, payable over an agreed period of time, which in this case is 6 months. So so how do you calculate Murabaha? So the formula for calculating Murabaha is normally the selling price equals to what? So the cost of the product plus the profit margin. It's an easy formula. So in our first example of the car financing, the cost of the car is 20,000. So it will be 20,000 plus the 2, which is the profit margin. In our second example, this is another example. If the cost, for example, is 100, so it will be 100 plus the profit margin, which is 10. So these are just but basic examples of Murabaha. Okay, on to the second financial instrument in Islamic banks. The second one is known as Mudarabah. And Mudarabah means profit sharing. So Mudarabah is a form of Islamic financially widely used in the Islamic financial system, which invokes a profit sharing arrangement between two parties. So we normally have two parties in Mudarabah. Number one, we normally have the provider of capital, Rabbul Mal, and the entrepreneur or manager known as Mudarib. So in this case, what normally happens is Rabbul Mal has the money, but he does not have the skills and the experience. But on the flip side, the Mudarib has the expertise, has the experiences, but he does not have the money. So the basic premise is that the capital provider, who is the Rabbul Mal, offers money for a business venture, while the Mudarib provides expertise and management. Then the profits generated from the venture are shared in an agreed upon ratio. So the profit will be shared based on a predetermined agreement between the Rabbul Mal and the Mudarib. But any financial loss is borne exclusively by the capital provider, while the Mudarib loses only their time and effort. So if there is a loss, of course, if there is profit, they are going to share based on the agreed ratios. But if there is a loss, the Rabbul Mal is going to lose all the money, and the Mudarib is going to, and the Mudarib will just lose their time, will just lose their time. So that is basically what is happening in Mudarabah, Okay. What are the importance of Mudarabah? So number one, there is the risk sharing. So Mudarabah promotes risk sharing, fostering a collaborative business relationship. So there is the element of sharing the profit and also the loss, because the Rabbul Mal is going to lose his money and the Mudarib is going to lose his time. Encouragement of investment. It encourages investment in various entrepreneurial activities without relying on interest. So if you just want to invest in any activity, you can easily get the finance. Economic development. This form of financing can stimulate economic development by making capital available for businesses that may otherwise struggle to secure financing. So there might be some people or some businesses that want to do business, but they don't have the money. So Mudarabah gives them that opportunity to have the profit or to have the finance, ethical investment. It aligns with Islamic principles by promoting ethical investment in business that comply with Sharia law. Now, what are the objectives of Mudarabah? Number one, profit maximization. To generate profits from investments which can be shared between the parties. So there is the element of profit between the Rabbul Mal and the Mudarib. Number two, resource mobilization, to facilitate the mobilization of funds for productive uses in the economy. Remember, the economy needs some resources. Businesses, people, they need resources, and the economy cannot basically grow without resources. So Mudarabah can provide that. Encouragement of entrepreneurship at Tijar, to encourage businesses initiative by providing funding to entrepreneurs who may lack sufficient capital. There might be some people who have the skills, who have the competencies, who have the expertise, but then again, they don't have the finance or capital. So Mudarabah will provide them with that. Fostering community development. So to indirectly enhance societal welfare through responsible investing and job creation. Now, what are some of the concepts related to Mudarabah? Number one, we've already said profit sharing ratio. So the Mudarib and Rabbul Mal, they have to agree on something. They have to agree on a certain percentage that they are going to share. Number two, there is the loss bearing. The capital provider bears all financial losses associated with the venture, while the Mudarib loss is limited to the investment in time and effort. So, for example, if Rabbul Mal gives like $100 to the entrepreneur, to the Mudarib, to invest, if the Mudarib invests and there is a loss, what is going to happen? Rabbul Mal is the one who is going to get like all the losses. He's going to bear all the financial losses. But the Mudarib will only lose what? The time and effort he spent on the business. Investment time frame, the duration for which the funds will be invested. So you find that in the contract of Mudarabah, there is a time limit. It's not an open thing. Then the nature of investment, the type of businesses or project in which the capital will be invested. The Rabbul Mal, of course, will give the Mudarib the money. But the Mudarib has to be very clear about the project or the business is going to invest in. It has to be very clear. Then termination rights. Conditions under which either party can terminate the Mudarabah contract. It has to be very clear. Under which circumstances can the contract be terminated? Under which circumstances can the contract come to an end? Now, what are the components of Mukawinat al-Mudarabah? The first one, parties involved. There are two. You have Rabbul Mal and you have the Mudarib. Capital, the amount of money or asset provided by the capital provider, the Rabbul Mal. Business activity, which is the project or business in which the fund will be invested. It has to be very clear from day one. Then profit distributions. There needs to be an agreement on how profits will be shared between the two parties. It should be written like Rabbul Mal is going to say, I'm going to give $100. Okay, and in case where we get profit, this is how we are going to share the profit. 40-50, 60-40, 70-30, 50-50. It has to be very clear. Contract, a formal agreement outlining the terms and conditions of the Mudarabah. Before anything starts, there should be a contract, and each party has to sign the contract. Now, these are examples of Mudarabah. For example, retail business. Retail business are the business center. Like they normally do what? They normally buy and do what? They normally buy products and they sell products. The business centers that you have in your countries. So a capital provider finances a retail shop and profits are shared between the investor and the shop manager. There is a business center. The business center needs some money. So the Rabbul Mal will give the business center the money. Hey, take this $1,000. invest, and then we'll share the profits, maybe 50-50 or 60-40. Real estate development. An investor provides funds for a property development project with profits from sales or rental share. There is somebody who wants to invest in real estate. So the investor or Abul Mal will give, hey, take the money, build the houses. Then after that, they'll agree how they will share the profit. Agriculture. A farmer receives funds from an investor to grow crops. You want to invest in agriculture. So what is going to happen? What will happen is that the Rabul Mal will give you the money. You'll go and invest in agriculture. Then you will agree on the percentages. Start-up venture. An entrepreneur creates a tech startup financed through Mudarabah. So an entrepreneur creates what? A technology, maybe in computer, ila ghairi dhalik. Then restaurant business also. You can also get a finance. You want to start a restaurant, you go to, somebody can decide to finance you. Now, how do we calculate Mudarabah? In an exam, you can get these questions to calculate the Mudarabah. You can be given some questions, so it's very easy. So an investor provides $10,000 to a restaurant, and they agree on a 60-40. This is very important. On a 60-40 profit sharing. If the restaurant earns 4,000 in profits, the distribution will be as follows. The investor will get 2,400 and the manager will get 1,600. You know, so because we are talking about the profit is 40,000. So what is 60% of 40,000? 2,400. That is what the investor will get. And what is 40% of 4,000? It's $1,600. That is what the manager will get. Then example 2, an investor invests 5,000 in a retail business with a 70-30 split. If the profit is 3,000, so this is how you'll calculate it. Like 70% of 3,000 is $2,100, which will go to the investor. And the manager will get 30% off. And the manager, in this case, is the mudarib. The investor is the Rabbul Mal. Will get 900, which is 30% of 3,000. It's as easy as that. It's the same in all these examples. Now, on to the third point, which is al-musharaka, musharaka. And musharaka, basically, is a form of partnership or joint venture in Islamic finance, where two or more parties contribute capital to a business or investment project and share in the profits and losses according to pre-agreed ratio. So al-musharaka, from the name in Arabic, tusharikuna fi shay. So it can either be a partnership of two people or even more. So this structure is based on the principle of mutual cooperation, at-ta'awun, transparency, ash-shafafiyya, then risk sharing. In our last lesson, we talked about the element of risk and how we share the risk in Islamic financial system. Unlike in the conventional system where there is risk transfer, but in Islamic system, we share the risk. Now, what is the importance of musharaka? Musharaka is we share the risk sharing. Musharaka allows for the sharing of economic risk among partners, reducing the burden on a single entity. So all of us, we share the profits. When it is loss, if we get a loss, then all of us are going to do what? To lose. Resource mobilization. It enables mobilization of resources from various partners, facilitating larger investment. If you want to invest in larger things, which requires a lot of capital, many people are going to come together. They're going to mobilize their resources, and you can venture in the project. Profit and loss sharing. The profit loss sharing aspect promotes ethical behavior and alignment of interest among the partners. So we are going to start this business, and we know that is al-arba wal-khasair is going to be shared between the stakeholders. Then support for entrepreneurship. Musharaka encourages entrepreneurial ventures, enabling startup and small businesses to access funds. Then alignment with Islamic principles. It adheres to Sharia law by promoting fair dealings without interest. So in Musharaka, there is no element of riba. Now, what are the objectives of Musharaka? ما هي الأهداف? Number one, it promotes economic growth. That is, it enhances productivity, al-intajiyya, and it fosters tanmiyatul iqtisadiyya. It encourages business, which is entrepreneurship. It facilitates ethical investment, al-istithmar al-akhlaqiyya, and it provides funding mechanism for those people who cannot manage the conventional, the kuffar system. So it provides them with an alternative. Then it also strengthens partnership. It creates relationship, trust, and cooperation among al-mustafmirin, who are the investors. Now, what are the concepts related to musharaka? Number one, in musharaka, we have capital contribution from each and every partner. For example, if we want to invest in a business and it costs 100, it has to be very clear. Each and every party, how much is going to be their contribution? Profit sharing ratio, how much or how are we going to share the profit? Of course, the profit has to be based on the capital. So for the person who invested a lot of capital will get a lot of profit. Loss sharing. How are we going to share the loss? It's also based on the capital contribution. Management rights. Who is going to manage our business? It has to be very clear. Then Sharia compliance. All agreements and operations must comply with Islamic law. So this is just the same thing you are talking about. Partners, the components of musharaka, the partners, the capital, the amount each one is going to inject in the business, profits and loss sharing agreement, business activity. This is very important. Which kind of business are we going to invest in? It should be a halal business. Then the partnership is going to be for how long? So the duration is of the essence. Now, these are just some basic examples of musharaka. You can have musharaka in real estate development when two partners invest in the purchase and development of a property. You can have musharaka in retail business, normal retail business. A small shop owner partners with an investor to establish a retail outlet. Agriculture, you can have musharaka in agriculture where partners pool resources. They bring resources to produce products and they share costs and profit based on their capital contributions. Then franchise business, an entrepreneur partners with a leading brand to open a franchise. So sharing initial costs and profit from operation. A franchise business is, for example, there is a business, for example, McDonald's. It's already there. It's an established business. So you can go and invest with them. Now, how do we calculate musharaka? Look at this example. We shall just look at only two examples. So we have partner A contributed $40,000. Partner B contributed $60,000. The total investment is $100,000. Now, they do their business for some time and they get the profit. They get a profit of $20,000. So then how are they going to share this profit? So it will be on a 40-60. So A, because he invested 40,000, which is 40%. So 40% of 20,000 is 8,000. Then 60% of the profit, 60% of 20,000 is 12,000. That is the profit. Example 2. Two people come together. So here we have 30,000. The other one gives a capital of 70. The total investment is 100,000. But here there is a loss. We don't have a profit here. So how are they going to share the loss? The loss will be based on the capital, their initial capital. So loss sharing will be, what is the 30% of 10,000, which is 3,000, and 70% of 10,000, which is 7,000. So it's as easy as that. So that is how you calculate what? Musharaka. And these are just the same examples. Now we also have the element of ijara. Now when we are talking about ijara, it's an important concept in Islamic finance that refers to a form of leasing or renting. For example, you build your house, you rent it. Every month you get some money from the landlord. No, you get money from the tenant. So it enables the lessor, who is the owner of the asset, to do what? To lease out an asset, real estate, equipment, vehicle, to the lessee, the user of the asset. So it for a fixed period and at a specific rental amount. So you can rent a car, you can rent a house, ila ghairi dhalik. Ijara contracts are structured to comply with Sharia principle, which prohibits interest. Now, what is the importance of ijara? Number one, it promotes asset utilization, as in it allows individuals and business to utilize assets, accessibility to products and services. You can access to products and which you wouldn't have been able to. Compliance, ijara is complies with Islamic Sharia. There is risk sharing. In ijara, risk is shared between the lessor and lessee. Then encourages investment between the two parties. And the objective of ijara is facilitate financing. Some people, they cannot get money, but through ijara, they can easily get access to the finances. It ensures compliance to Islamic Sharia. It encourages entrepreneurship, fosters fairness, which is equity between the two parties involved, and allows for flexibility. Now, the concepts and the components are basically the same. Lessor and lessee, these are the two parties involved. For example, if it is a house, you have the landlord and you have the tenant. The asset, you have the house. Rental payment, you agree, the tenant, okay, I will be paying you $200 every month. Duration, every month I'll be paying, or it can be for 1 year. Maintenance responsibility. Who will be responsible for maintaining the house? Is it the landlord or is it the tenant? It has to be very clear. So this is it. The same thing. Parties involved, lease asset, the rent income, the lease term, and the terms and conditions. And examples of ijara, maybe you can have vehicle lease. I have a car and I'm leasing the car to somebody. Hey, this is my car. Somebody is renting my car maybe for 2 months, 1 month, some few weeks. Equipment leasing. A construction company leases heavy machine. There is a company that is building houses. So what it does, it leases the machine. Then real estate lease, renting commercial property, computer and technology. So the bottom line, you can lease and rent many items. Now, how do we calculate ijara? So for example, we have the asset cost is 20,000. The lease term, you are leasing it for 3 years. The monthly payment is $600. So what is the total lease payment? It's just 6,600 times 3 years, 36 months, which is 21,600. Number two, asset cost is 30,000. The lease term is 4 years. The monthly rent is 700. So it is just 700 times 4 years. In 4 years, you have 48 months. As easy as that. Now then lastly, we have the sukuk, which are the Islamic bonds. And sukuks are financial instruments in the Islamic financial system that represent ownership in a tangible asset, service, project, or business venture. And unlike conventional bonds that pay interest, Sukuk provides returns derived from profits generated by the underlying asset or project adhering to Islamic principle Sharia, which prohibits riba, which is interest. So Sukuk, like I explained in our last lesson, they are asset-backed financial instruments. So for example, a government wants to build a hospital, and the government does not have enough money. The government will approach you. And when they approach you, you will give them the finance and they'll give you the sukuk. So the government, they'll go to invest in the hospital and they'll pay you back based on the profits they're going to get from the hospital. So the sukuk is compliant to the word Sharia, diversification. They offer an alternative investment vehicle. Infrastructure development, sukuk can be used to fund infrastructure. Liquidity, sukuk can enhance liquidity. Liquidity means it can give enough finance. We inject a lot of finance in the economy, and it also offers stability, economic stability to the economy. And the objective of sukuk is just like all the financial instruments, facilitates investments, raising capital, promoting economic development, ila ghayri dhalik. So we only have 1 minute remaining, so I think we'll continue tomorrow. You'll just read the remaining part. We have like 3 slides remaining, So you'll just read the remaining slides. Then there are 4 slides remaining. So you'll just read it and then you will do what?
Okay, inshallah. Thank you.
Okay, we'll meet tomorrow, inshallah.
Inshallah. Thank you. Jazakallah khair.
Okay, afwan.